Welcome to another weekly Friday chat. We're going to go over the update on the debt ceiling issues and jobs report numbers. Let's do it. All right, so I think the government, the Treasury, the Democrats, the Republicans, I think they've seen the light.
Have you seen the light?
So the bill to raise the debt ceiling another 2 years out, pushing it to 2025, has been approved by the House. It has now been approved by Congress. We're just waiting for the president now to sign off on it. So I can't imagine that that's not going to happen. As of the recording of this is 12:05 on Friday. I kind of waited as long as I could to record our Friday weekly chat to make sure to kind of get the most up-to-date information. So that's where we stand with that. Again, I think we're kind of done with that. I never really thought or really had any concerns. Like we've spoken last week, we've never had a debt ceiling. We've never defaulted. We came close in 2011. I was hoping cooler heads would prevail, and it seems like they have. Well, kind of what we were hoping would happen when we kind of had the debt ceiling resolution in play. And again, we don't have a definitive approval yet because the president hasn't signed it, but we're anticipating that will be done well before Monday. The markets are loving it. So you can see the markets are up across the board. Stocks are loving it. Dow's up 1.85, S&P right here 1.3. So markets are happy. Markets are loving it, hoping we'll have a nice little rebound in June to make up for the not so great May that we had. Also, look for our monthly Wrap the Markets, which will be coming out sometime next week. So stay tuned for that in your inbox. So I was talking about the stocks. The stock market loves it. The bond market, not so much. We can see here our 10-year yield's up 1.8, 5-year yield up 0.3. Again, when yields are up, bond prices are down. It has an inverted relationship. Why is this happening? Well, we had a jobs report come in. And in our jobs report, we kind of had mixed reviews. Okay, so the jobs report came in. Now, jobs reports are interesting when you're looking at it in relationship to how the stock market's going to perform. Because a lot of times, good news is bad news is good news, huh? Doesn't really make sense.
It makes sense.
Yeah, join the club. But it does make sense, though, when you really think about it. So a lot of our market, stock market and bond performance and interest rates are driven by what goes on in the economy, and more importantly right now, what's going on with inflation. So a stronger job environment creates more money. It's more money supply, which then turns making to combat inflation harder. So in the really only way, or one of the major ways to fight inflation is to reduce the money supply. And the way you reduce the money supply is less people are employed. So less people are employed means a worse economy, hence means a better stock market. Got it? Okay, good. But so what's happening is we're seeing that last month at the month of May, employers added 339,000 jobs, but unemployment also rose. So it's kind of a mixed bag. So we kind of have both things going on right here. So again, kind of a mixed bag. The Fed did come out and say that they were going to pause on raising interest rates, but then they did say that they are probably going to resume after the next month pause. So what we're seeing is when you get reports like this with the jobs report where they're mixed bags and still seeing a strong job market environment, it lends us to believe that the Fed will continue to probably raise rates another couple of times this year. All right, well, that's a wrap on another weekly Friday chat. I don't know about you, but it's been an exhausting week with debt ceiling issues. Not so great. I'm in the market this week, although today's better. Again, check out our Wrap the Month, which will be out next week sometime, hopefully. And I'm ready for some pizza. I don't know about you, but you know it. Fridays are for pizza. See ya.